Hi everyone, welcome to Buffett and Beyond Research Saturday ETF Report, and this is May 25th, 2024. And remember, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And this week we're going over some chart formations because, whoa, is there a reversal in our top ETFs going on here? All right, let's look at the QQQs first of all, and let's come over here, and here we have a little top. Now, see what happens when it goes over here or becomes overbought. Yeah, we get a correction, but right now the correction has always been down to the 20-day moving average, which is this green line. But let's take a look at this. So we have a reversal here, a little one. This is a very, very short-term indicator, and we look over here and we see this one big day, which was Thursday, and the market was, or this QQQ was above and below the day before, so that's called an outside day. And then what happened on Friday? Well, Friday it actually turned around and reversed and went back up again. However, let's come down here because that one down day had pretty high volume right in here. And has this indicator begun to turn over? Well, folks, I'll tell you what, right now we're in the middle of a 3-day holiday. So leading up to a 3-day holiday, usually the market is pretty good. And then we have the end of the month coming up next week. It'll be the last week of the month. And usually the end of the month, the beginning of a new month, are bullish for the market. So we have this little problem here that, yeah, we do have a little reversal going on up here, but is it going to be very big at all or just another fly in the pan? But we're watching this down here. And let's look at the home builders. And the home builders is a different story because some of the analysts out there are saying that the Fed might not have to reduce rate or just not reduce interest rates this year at all. Well, that sent interest rates up a little bit. That's sending the housing market down quite a bit. We've got this double top in here, and we are sitting below the 20-day moving average, again, which is this green line, and the 50-day moving average, which is the blue line. So we have a little bit of a problem right in here. Then when we come all the way down here, yeah, that's a sell signal on our intermediate term indicator. So we're probably going to go down and test this area in here. So right now we're looking at some nice home building stocks that have done very, very well, and all of a sudden they're starting to get weak in here because the whole sector is getting weak because of higher interest rates. So that's what the market has to contend with. All right, let's go to the S&P 500. We're seeing that same topping formation, and when we come down here, we are seeing this indicator turn down, but it's not. It's got this black line's got to come down over that red line to give us a sell signal, like over here. Once we did it over here, we came down, we got a nice sell signal. We actually went short. We didn't go short the whole index, but we went short with our hedges. So we made some money on the hedges on the way down, got this double bottom here, and then we made money because we went long back up to here. So we did pretty good in this particular time frame. But is this turning around? And that's what we want to know, because we won't know until next week, folks, which is coming up in a couple of days. We have a 3-day weekend, and we don't want to spoil it. And let us look at the Dow Jones Industrial Averages, and here we have a little bit more of a story. We see the Dow down below the 20-day moving average. That's close in up here. And now the market went up to test this 20-day moving average. So it went down below it. Now it's going back up to test it. And I'm recording this just about a half hour before the close of the market, and we'll see where it closes right in here. So that'll be very interesting. And you'll see this in the Saturday market recap, which I do on Saturday morning. And just take a look at that, and we'll see how this market actually closed. Down here, we don't care for that, folks. We don't care for this turning around. And it looks like that black line wants to go down over that red line. So we'll see. Now, let's look at the QQQs and how we've been doing. So what we do with the QQQs, those stocks are 100 stocks, or the top 100 stocks in the NASDAQ, and we pick them, and of course you know our strategy. We pick the top stocks using the clean surplus methodology, and we outperform the index just about all the time. So the QQQs, what are they doing right now? They're up about 12% as I'm recording this, with the S&P up about 11.3%. So they're pretty even right in here, folks. And then, by the way, we took Tesla out of this portfolio. Yeah, it wasn't doing very well for us. And will it do better in the future? Well, we'll leave it. It's a car company. We've got other good stocks in here. We're up 24.7%. That's double the S&P 500, double the QQQs themselves. So our top stocks in here are up 24.7%. Now, what if we hedged about 30% so that when the market falls, this portfolio does not fall as much as the market? In other words, can we take some volatility out of this portfolio but yet outperform the S&P 500? Because remember, out of any 10-year period, 96% of professional money managers who manage the publicly traded mutual funds, 96% cannot outperform this S&P 500 index over any 10-year period. So this is the holy grail in there, folks. Now, can we develop a portfolio and use hedging in order to have less volatility than the S&P 500, but still outperform the S&P 500? What if we had hedges on for about 30% of the portfolio all the time? So we're doing two things in here. One is timing those hedges, and the other one is keeping them on all the time. So if we just had the hedge, and what do we hedge with? We hedge with the inverse QQQs, which is SQQQ, and that stands for short. So when you buy some of this, you are short the QQQs, and in this case, it's a triple inverse ETF. So if you put 10% in this, you are insuring your portfolio 30%. 3-for-1 inverse ETF. Very, very neat. Why are they even around? They are around because when you're in an IRA or other qualified money plans, you're not allowed to go short. So you can't protect yourself without buying puts and spending a lot of money. So what they came up with, some nice bright fellows came up with inverse ETFs, so you can buy this, but yet you are short a certain amount of the portfolio value. So if we use 10% of our portfolio, we can hedge 30% of that portfolio because it's a 3-for-1 inverse. So if we time that, we've been timing it from the beginning of the year, we actually have not lost any money. So we got in when the market went up, we went down, got in when the market went down, on and on. So we're standing here at this hedging did not cost us any money. But we still had to put 10% of our portfolio into it, and thus 10% is in this inverse ETF, which means we only have 90% left to buy these stocks, which are returning 24.7%. So we have to take this 24.7%, multiply it by 0.9, because we're only putting 90% of our portfolio into it, and that gives us a 22.3% return. What if we were fully hedged all the time at 30%? So in other words, rather than trying to time it and buying and selling, because it's always nice to have a money manager do that for you so you don't have to worry about it, we would have lost 8.8% on the portfolio. So if we only put 90% into this portfolio and we lost 8.8%, we would have about 13.5%. So in other words, if we were hedged 30% all the time, we're still returning 13.5%, which is more than the S&P 500. It's even more than the ETF itself, the QQQs. And we have less volatility than either the QQQs or the S&P 500. So this is pretty nice, folks. This is one way of doing it by hedging, but still getting into some of the top stocks like NVIDIA, like Avago, like Apple, like Google, like Netflix. Or you don't have to hedge at all, and you would be up more than double the S&P 500 and more than double the QQQs themselves. So you have your choice here. You can hedge a little bit. You don't have to hedge at all, or you can hedge about 30% all the time. Now let's see our sector all-stars, and what we did here, why we call them the sector all-stars, is because we take some of the semiconductor stocks, we take some of the tech stocks, some of the housing stocks, and we put them all together, and we have a pretty nice portfolio. So what have we done with those stocks? Well, we're up 19.5%. Again, the S&P up a little over 11%, but we're up 19.5%. Had we been hedged and using timing to put those hedges on and take them off, we'd be up 17.6%. So doing very, very well in here, folks. Don't forget, the market is up 11.2%, and 96% of portfolio managers are not doing as well as the S&P 500. All right, so if we hedged using timing, we'd be up 17.6%. And don't forget, by using timing, if it's used correctly, we are lowering the volatility of our portfolio, and yet we are still performing better than the S&P 500 and, in this case, the QQQs themselves. If we were constant and had the hedges on all the time, we're still up 8.9%, very close to the S&P. But we took a lot of volatility out, and we don't have to worry about putting hedges on and taking them off again. So that's a very, very nice place to be, folks, using these inverse triple ETFs is what they're called. And again, they were invented because we're not allowed to go short in IRAs or other qualified portfolios. Now let's look at the home builders. The home builders, as we saw, have given us a sell signal, but what have the top stocks in our home builders done? First of all, what did the home builders ETF do? It's up 10% with the market being the S&P 500 up 11.3%. Our top stocks up 16.2%. If we're hedged using timing, we're up 14.6%. And now here's something that's very, very different. If we use the inverse, and it's called DRV, if we use the 3-for-1 inverse home builders, that actually made money for us. So this is highly unusual. So I don't suggest you go out and use this yet until we finish a lot of testing this year on this particular home builders ETF. But had we done it, had we used it, we'd be up 20.4%. So, but it's supposed to be losing money in a situation, especially when the home builders is going down. The inverse hedge should not be going up. This should be going down. We just don't know how much. So we have to see if this inverse ETF works at all, because we just started using it in our trial portfolios where we've been using the inverse QQQs a long time now. So we know how that works. We know how it operates. We know exactly what to expect. And since we've used it, we know a lot about it. But with this DRV, we haven't used it at all except for the past couple of weeks, and it's doing well for us, but it's not supposed to be. It's supposed to be a hedge. It's insurance. It's supposed to cost money. Instead, it's making us money. So we have study to do on this. Do not go out and buy until we figure out what's going on with this. Okay, now what we did here is we put the home builders, which is this brown line in here. All right, the black line is the S&P 500. The brown line is the home builders. The QQQs are represented by this blue line. And what I'm trying to see are the home builders, which is this brown line, perform very close to the QQQs, because guess what, folks? If it does, then we could use the QQQs to hedge the home builders. So we're following the brown line and the blue line, and we could see, boy, oh boy, they pretty much move together, don't they? So yeah, maybe we could use the QQQ hedge for the home builders also, or combine some of the home building stocks, the best home building stocks, with the QQQs. So we have some alternatives with us if we want to be in the home building stocks and do away with some of the volatility that's in it, because don't forget, they're as volatile as the S&P 500, and we're trying to get rid of some of that volatility. So this is a very, very interesting concept, which we are following right now, and we are using it right now. So we'll see how it goes in the future, because right in here, we could see the blue line and the brown line. Blue line again, the QQQs, the brown line again, the home builders, and right in here, they are exactly together. So if they move together, then we could use one to hedge the other. Very, very interesting concept. So, folks, we've had a wild week this week, especially on Thursday, when we've had the worst day in the market in 2 months. And so it's a 3-day holiday. Let's go out there, forget about the market, because it'll be here next week. Be with your family, be with your loved ones. Take your mind off the market. Go out, have a good time. Most of all, stay safe. So, folks, we'll see you back here in a couple of days.